Well, hi, ladies and gentlemen. Welcome to the webinar. My name is Chris Weston. I'm head of the research team here at Pepperstone. We're going to have a look today at a title which I think is really, really important. It holds so much influence over things like implied volatilities in markets, which of course have such a huge influence over things like managing risk and position sizing and various factors as well, and what assets you're trading, what vehicles you need to trade. So yeah, we're just taking a very strong top-down approach as to the sort of backdrop that we're looking at, and really having a look at what is happening in the US and global economy. Are we heading into a recession? What are the indicators to see that will really give us a high conviction that we're seeing a recession, and therefore what kind of vehicles we can look at. So we titled this one A World Looking Over the Edge, and we hope you enjoy it. And if you've got any feedback or questions, do reach out to Sean or I and the team at Pepperstone, and we can explore those in more depth. But I'm going to welcome to the webinar Sean McLean. Sean's been with us for a period of time, and he sort of brings a more statistical approach to financial markets, looking at sensitivities of currencies and indices over economic data points and various factors like that. So welcome to the webinar, Sean.
Thank you, Chris.
So I'm just going to quickly talk to you about the disclaimer. I think that everything you say today is a reflection of Sean and mine's own views. They do not represent our employer, Pepperstone. So please take a moment just to read the disclaimer in that situation. Everything we say should be considered general advice as opposed to personal advice there.
Okay. So Chris mentioned that there's been a lot of talk about recession recently, and we're hearing that not just from clients calling in and asking us about it, but looking across Google Trends, looking across the press, it's a hot topic. So we've tried to find a way to quantify that, and we've looked at Bloomberg's reporting on whether they've been talking about recession and also currency wars. So look at this chart here. You can see the white line recession. It's been trending in August. It spiked a bit, and that got up to about 3,000 news articles, and it's a considerable spike on the month before. And then at the same time, we had almost 500 stories mentioning a currency war in that same month in August. So why is it trending? Wherever I seem to look, anyway, if I'm just reading the press, we're seeing a lot of negative headlines. We've got bond yield inversion, we've got cash rates reaching the zero lower bound, even in negatives, we've got global manufacturing falling. So we're in this news environment where it feels like the sky is falling. So I suppose what we want to know is, where are we really? Should we be worried?
Well, I think the theory at the moment is that we've kind of got this Goldilocks scenario that is playing through. Now we kind of take the view that that's going to change fairly soon, but at the moment, I think we can take the view that if you have a look at implied vol in FX, I mean, apart from the white line, which you can see is 1 month sterling against the US dollar implied volatility, which is picking up because that's kind of an idiosyncratic event. That's what's happening in the political sapphire that is the UK Brexit negotiations. The market is expecting higher volatility in cable, but if you have a look at Aussie dollar and euro dollar and even dollar yen, implied volatility has been very low. So that's been somewhat down to the sort of, I want to call it the Goldilocks scenario, which we expect to change. We're going to give you an indicator to suggest that will change. But have a look at euro dollar implied volatility, 1 month implied volatility at 5.5%. That's very, very low on the green line, which you can see there in the bottom right corner. Go into equity volatility and have a look at the S&P, and we've got the white line here representing the 10-day realized volatility for the S&P. We're back down to very low levels, just above 5%. Implied vol, 30-day implied volatility just in the S&P over one optionality is trading at 9.8%. This is slightly different from the VIX, which is trading at just over 14%. But there's a reason why we've seen very, very low FX volatility implied and realized, and what we're seeing in the equity market, we've hit this sweet spot, I think, which we want to explore.
Yeah, Chris, you mentioned low vols, and that might be the case in the US, for now. But in the rest of the world, there are a few points that look a bit concerning. If we jump into the German data, we can see that German manufacturing is declining, and it has been for most of the year. And if you jump to the next slide, we've got Korean data as well, which Korean exports started falling quite rapidly this week. So if it is all looking okay in the US right now, what do these trigger points mean for the US?
Well, eventually they're going to spill over into the US. So, I mean, if we look at what's happening in the IFO survey, we've got that coming out tonight as we speak, and that's been a pretty good precursor for German GDP. So, yeah, I mean, the German the manufacturing numbers 40, just over 41, so deep contraction coming through there. It's a 123-month low. Look at the business expectations. You know, they've been a really strong precursor for where current assessment's going to go, and then the overall GDP numbers. So Germany and Europe's looking a bit weak. You know, you've got Korean exports there, which have fallen 21.8%, which you can see that as the white line. And actually, if you look at that in the manufacturing numbers in the US, you can see that they've actually had a pretty strong correlation. So that's manufacturing at 49.1. We get the next manufacturing number in the US coming out on the 1st of October. So that Korean export numbers, you know, that was distorted by some festivals that were going on, a festival that was going on over there. But there's no doubt that the market has been using the Korean export number as a precursor for what could be, you know, could materialize in US manufacturing. So I think that's been an interesting one, that the global economy is looking a little bit weak at the moment. I think there's no doubt in my mind that we can start with Fed policy. When we're thinking about central banks, we think about three central banks as the price makers, and the rest are fairly reactionary and take prices and will be price takers effectively in that situation. And there's no doubt in my mind that we are coming to a point now where you know, what's happened is manifesting itself into the global economy. Have a look at the Fed funds rate. You can see that as the red line there. You know, we've had 9 hikes from 2015 to 2019, and we've seen the Fed funds rate cut twice, but that coexisted with 16% decline in the balance sheet effectively, which would have probably added an extra, been the same equivalent of about 50 basis points. So liquidity coming out of the markets. Now we can actually see that is turning around. The balance sheet is now turning around, but I think this has really infiltrated the global economy. I think that what has actually, you know, played out through 2015 to 2019 is really starting to impact as well.
Chris, does this mean that the Fed tightened too much?
I mean, you can make that argument. Now, let's go to this chart here. I think is a good one. And what we can look at is the modelling of the market's interpretation of where Fed policy is relative to the long-term neutral rate. So we can use the five-year forward rate as our neutral rate. The neutral rate being the level that the market stipulates as the perfect policy setting relative to their inflation expectations, relative to growth expectations. Now, what we're seeing is if we look at the 5-year forward rate minus the US 3-month Treasury rate, and we use the 3-month Treasury rate because it's very closely proximate, you know, a good quasi proxy of the Fed funds rate. So what we'll end up seeing is when the 3-month Treasury yield trades above that of the neutral rate, the market's saying that the policy is too tight, and that would be a situation here where that line goes below zero. So what we're seeing is that the neutral rate is trading with a lower yield than that of the US Treasury 3-month, what effectively is seen as the proxy of the Fed funds rate. And what we can see here over time is when we see the neutral rate trading below that of the Fed funds rate, the market is saying that policy now is too restrictive, and you can see these red shaded areas. And as we go through these charts, through these slides, you will see these red shaded areas representative of recessionary periods. And what we see, is yeah, you can see a situation where the policy becomes too restrictive. And then ultimately what ends up happening is the Federal Reserve, you can see here the Fed funds rate, this is the US interest rate, they start cutting aggressively into a recession. And what ends up happening is the neutral rate that will then start moving up more aggressively relative to the Fed funds rate. And the market is saying as we get to this point up into sort of 6% level, that now that we're getting to a much more expansive monetary policy setting, that the level of what is considered to be the neutral rate is significantly higher from where the Fed funds rate is. And then that's kind of the point when we start seeing economic expansion and the Fed then suddenly have to tighten again, which is kind of what we see here. You can see in this environment here where the Fed funds rate or the 3-year Treasury rate effectively goes below zero, and we're getting into a much tighter period here, and that's exactly what we're seeing here. So at the moment, you're seeing a basic model on what the market considers to be Fed policy is about 1 rate cut to get back up to a point where the market is no longer restrictive. So I think in an absolute policy term setting, we need to, based on this model here, that they're saying that we need 1 more Fed rate cut to effectively get us to a point where we're at the neutral rate. So at the moment, the market is saying we're still a little bit too restrictive. I think the other consideration is what's happening with the dollar. So we've got still a somewhat restrictive Fed policy setting relative to what is considered to be the neutral rate, the future neutral rate. And that is what's happening in the US dollar. Have a look at the white line there. You can see that the white line represents the trade weighted US dollar. You've got the dollar index, which we offer as USDX on MT4, MT5. And then you've got the emerging market index. Now that emerging market index has only been made here from JP Morgan since 2010. But you can see here that emerging market currencies have really been underperforming. Again, this sort of manifests itself into the US. We talk about our dollar, your problem. That was a phrase that was coined many years ago. But I don't think that's the case anymore. I think the Fed are the world central bank. They need to set policy for not just the US economy, but the global economy. US GDP represents about 15% of GDP these days, and it was much higher at a stage before. So they need to get the balancing act right. If global growth is going to slow down, specifically that in emerging markets, it will eventually infiltrate that of the US. So, we've got a strong dollar that's obviously hurting emerging markets to an extent. We've got, obviously Europe looking pretty precarious. Certainly Germany is probably in a recession at the moment. Korean exports are giving us some signs that manufacturing still has some weakness to go. And I think the other situation, Sean, is that we've got a Federal Reserve that are loath to really want to move. If you have a look at the dot plot projection, you can have a look at here. These are the calls of where various Fed members see the Fed funds rate over a specific period. Now, if we take the medium number, you can see that this year the central thesis or the medium thesis is that the Fed funds rate will not go any lower. And that's the same in 2020. Okay, there's only 2 dots, but then we actually start expecting to see rate hikes. That's one issue. So the Fed on a medium basis is saying that we're probably done. We've reached a low point in here. And that's quite concerning for a market that sees Fed policy as somewhat too tight, by about 25 basis points, according to my basic model. But there's also massive divergence on 2 points, which I think is really, really interesting. One is the divergence that you're seeing amongst Fed members. So you see here that we've got 5 members here calling for rate hikes at this point and said that Fed policy is too high. And then you've got 7 members here which see another rate cut this year. Now we expect to see one more rate cut this year, probably playing out either in the next October meeting or probably the December meeting. There is no November meeting. Then you can have a look at what goes on here. You can see that divergence really playing out. The divergence amongst Fed members is really, really high. But it's not just that. Have a look at the divergence with market pricing. This is using swaps pricing. And you can see here that we've got about 60 odd basis points of difference between the median point of where the Fed is and where the market sees things playing out. So that's a really interesting concept, is that it does concern a little bit that you've got a Fed that believe we're at a point where they've probably got the Fed policy right. And again, that's probably because their models are looking at the data points that we're probably going to show you in a minute. The other point as well is I think we always look at fund flow. If you're a trader, you always follow the money. You have to follow the money. You have to see where it's going. And I think this chart on the right here from Goldman Sachs talks about where funds have been going on mutual funds and also ETFs. There's been a lot of money flowing out of mutual funds this whole year, out of equity funds, a lot of money going into bond funds. I don't think that's going to surprise anyone. Yeah, we're still pretty bullish on duration. At current levels, we think longer term, there's still further downside in yield. But also, you can see on ETFs, there's been a bit of inflow there, but on the whole, there's been, decent outflows of equity funds. And where is that money going? It's going into money market funds, the safest of all safe havens there. You can see short-term money market funds have really been attracting cash. And that's similar to what we saw in 2008. The sample doesn't go back particularly far, only goes down as far as 2007 here, but you can see that in the lead up to the GFC, you saw massive inflows into money market funds. That's kind of happening now. So does this give an idea that we're going into a recession? Well, certainly the money is flowing into assets that benefit from a recession, and that's kind of where we are at the moment.
Okay, let's take a step back then and think about where we are in the cycle. I remember, when we had those the rate cut from the Fed in July and August, Powell called the rate cut a mid-cycle adjustment. And that was quite confusing for the market at the time, because I think a lot of people were feeling that we were probably closer to an end cycle rather than in a mid-cycle, with global growth tapering off, equities slowing, high beta stocks underperforming low beta. I think people were a bit confused and didn't really buy that we were in a mid-cycle adjustment. And the Fed have since they haven't really referred to them as mid-cycle cuts again, have they, Chris? They've started calling them insurance cuts.
Well, I mean, I think they for all intents and purposes, I think Powell was loath to to go it verbatim and say mid-cycle, but I think for all intents and purposes, he still feels that's the case. But I think let's have a look at a few charts that really give us a clear sense of where we are. And why volatility is probably low. Now we have seen a situation where manufacturing has been weak. It has been weak for some time, not just in the US but in global markets. You can see here the red line, which, as I say, the next print of manufacturing comes out on the 1st of October. But we've seen ISM manufacturing numbers in the US going into deep contraction, or going into modest contraction, we say. But the interesting thing here is that the global PMI series that JP Morgan have been making for a couple of years now has been in contraction for a few months. And this has been, people in the market size are saying this is a forward-leading indicator. This is the litmus test. And what's interesting here is that the US, which was powering ahead and getting ISM manufacturing numbers which were above 60%, above 60 on the index, which was thematic of an economy growing somewhere around sort of 4%. That's now caught up. So what was once an island in the sun, and everyone's saying, well, this is just working so nicely, has caught up with the rest of the world, and therefore you're not immune. And I think that's an interesting thing, is that manufacturing has been weak. But I think as the market's sort of gone on, you can see that there has been this strong correlation. So the market is really fixated on manufacturing. Manufacturing is 11% of US GDP, but if you have a look at how this is compared to the US 10-year Treasury yield, as manufacturing has contracted, you can see that, or grown at a slower pace, you can see the sensitivity to the US 10-year. And of course, if the US 10-year is a proxy of what's happening in economic development, it's probably having influences on things like capital flows into the dollar, what's happening in things like the S&P as well. Now, I think what's interesting here is that we have seen this little bit of a tick up in the 10-year, which suggests that the next ISM manufacturing print is going to be a little bit better. But you can see that the market has been really fixated on this manufacturing number. So when we come to October, you really do need to keep an eye on. This is something that we are really focused on. So manufacturing has been weak. We can also have a look within that subcomponent and see that new orders have been coming out of 3-year low, or the headline number 3-year low. New orders have been 7-year lows. So the subcomponents have given us some cause for concern. Have a look at the chart from Deutsche on the right-hand side. We're looking at world trade volumes. That's obviously been a reflection of what's happening in the end of globalization, the idea that you're seeing supply chains being removed and changed. The US is sort of having this trade tension, this trade spat with China, which we're seeing how that's going to roll out. Our view is it's probably not going to get really settled before the election in 2020. Obviously, the UK and Europe are going through the Brexit scenario. The US is taking on other jurisdictions such as Japan and Europe and Mexico. And so we're end up seeing this sort of more fragmented stance on globalization. But have a look at world trade volumes and have a look at FedEx as a leading indicator for world trade volumes. So if world trade volumes are falling, that will have an impact on global growth. Have a look at CAPEX. Corporations investing in themselves or planning to invest in themselves. You can see here the blue line on the left-hand side, they've been falling away. And again, that has implications on the level of hours that are being worked. So, what's been happening in terms of the number of hours that people have been working, less hours, obviously that's going to have an impact on economic output as well. So I think those 3 charts are where the bears and the economic doves have been saying, that's a concern for us. Manufacturing, trade volumes, global world trade volumes, and also fixed asset investment, but the plans for corporations. And these are forward-looking indicators. So you can tell that people have been concerned. But if also, what's probably more keeping things stabilized and what's been suppressing vol, and why the Fed is still seeing this as in a mid-economic cycle, well, employment's been very strong. We've got full employment, we've got wages which are okay. The service sector is doing pretty well. You can see that from the white line here. It's been ticking up. The services are about 70% of US GDP. Inflation expectations are sort of hovering around 2%. They're not at danger levels. Come back when we're through 170. But 5-year inflation swaps are sitting around 2%. They're not going to worry the Fed too much, especially when financial conditions are still quite accommodative. And also, if you have a look at core CPI, I know the Fed look at PCE, but the market's been way more sensitive to core CPI. we're at 2.4%, with the highest levels really for quite some time, and that's trending in the right condition as well. And core PCE will head in that direction. So I think if you're looking at that as the sort of two-tiered economy, inflation's not really troubling the Fed too much. The service side of the economy is looking pretty good. And also on the other side of things, of course, the labour market's looking in very, very rude health at the moment. So, late to the party, I know, but the Federal Reserve, their models at the moment are going to be talking about what's happening there. The other point is that when you have a look at things like the Citigroup Economic Surprise Index, and you can see here the yellow one looks at the surprise index on the US, and the green one looks on major economies. And the bottom line with this index is this looks at the performance of data points relative to where the consensus sits. So if the data is beating by a certain percentage, there is a model which says that this goes up. So what you can see here is from this double bottom that we saw earlier in the year, that the data in the US has been consistently outperforming the consensus, and it has been okay, but you can see there's been a consistent beat coming through in not just US data but also global economics. So that's the sort of fragmented tug of war we've got. We've got weakness coming through in manufacturing, trade volumes, and also in terms of CAPEX. But at the same time, on the whole, data has been beating expectations both in the US and in the US, and we've gone this kind of not so bad trade. Services look okay, employment looks okay, and that's why we've got the situation where volatility is low and they've got central banks supporting markets. So how does that dynamic change, I think is the kind of answer there.
Yeah, so we look at market-based models, and this one's from the New York Fed website. It's their recessionary model. It's built on market-based dynamics, notably what's happening in the bond market. So if you look currently, here we are, 2019, the New York Fed is telling us that currently they're seeing a 37% chance of a recession within the next 12 months. And so if we're at 30%, look at this, look at the trend line here. Every time, we go up, we hit about 30%, we're in a recession. Again, we hit 30%, we're in a recession. And that's been the trend since the 1970s. So that 30% seems to be a tipping point, Chris, and that one chart alone looks quite alarming to me looking at where we are now. What other recessionary indicators should we be looking at?
Yeah, I think it's important to know that this is based on where the market dynamics, as you say. I mean, we're talking about parts of the yield curve, but for us, I mean, the market, and I think part of the reason we're at this implied probability of a recession, which, as you rightly point out, has actually always, anytime above 30%, has led us into recession, as we see these red shaded areas have been recessionary environments. I think these are the ones that we're looking at really closely to give us a sense of what happens. So first of all is the Conference Board leading index. Anything below 0 has been a pretty good precursor of recession. We've had this one false break that happened in 95, 96, where we sort of briefly went below 0. But this is the 10 leading economic indicators. Things like jobless claims, new orders of manufacturing, the S&P leading credit index, and various other factors that make up what they consider to be a leading indicator for the US economy. And again, we're focused very much on what's happening in the US because we're seeing vulnerabilities in other markets, but the market itself is really focused on the US. What happens if we do hit a US recession? There's going to be shock waves across the world. And we also need to consider, if we do see that, how are we talking about a shallow recession or something more protracted? And also, can therefore central banks save the world in this situation, or are we going to have to see a fiscal response? So these are the indicators that we want to look at. First of all, you can see here where we start seeing big declines. You see this sharp move down into a recession. So the indicators really looking at, go below 0 and then into a recession, go below 0 into recession, go below 0 and head deep into recession. And at the moment, you can see that we're hovering at 1.1%. We haven't got that trigger point at the moment, but it's very much on the radar. So again, this is one which has been a pretty good. We've got a decent sample size here, and pretty much every time, with the exception of once out of this sample, when this goes below 0, and it's the rate of change that's obviously very important. That we head into a recession. So we're not there at the moment. The forward indicators here are suggesting, very much on the high watch list, but we're not at a dangerous tipping point at this point. Again, we go back to what's happening in core CAPEX orders, and what we can see here again is generally when we see below zero, we can see that sharp move down, and that's actually been a really good indicator for what's happening in the S&P. This has been very correlated. Now, of course, as we went into 2013, we ended up having QE programs and QE3, and that's kind of distorted the idea about businesses investing in themselves. But you can see again, when this has a sharp rate of change, I've put the 3-month indicator here, the 3-month average here, just to smooth it all out a little bit. But what we're seeing is a situation when that does go below zero, and we're in the absence of any kind of major QE program, this has been a pretty good indicator about where the US economy is going to go, but also the S&P as well. Now, in a situation where businesses are refraining from investing in themselves, and we do see economic output starting to fade, of course, the first nut to crack is going to be, or one of the latest nuts to crack is going to be the labour market. And what we look at, rather than necessarily the MBS number or the BLS number, is what's happening in jobless claims. I think this is a really good indicator for me. That has been a pretty good precursor for recessions. And that's because if businesses are going to cut back, if they see slower growth going forward, then they're going to cut back on the labour force, and you're going to see a spike in jobless claims. We've looked at the 4-week moving average of jobless claims relative to the 3-year average here. So you can see that when the white line, which is the 4-week moving average, spikes higher and breaks through the 3-year average, we tend to see that rate of change picking up into recession. Picks up, breaks through the 3-year average into recession, breaks through a 3-year average into recession, and you can see jobless claims really spiking high. At the moment, the jobless claims are very low. We're at multi-decade, if not all-time lows coming through. And again, if we start to see that spike, if it goes through the 3-year average, that's going to be something that really comes onto our radar. Jobs, the forward-leading indicator, of course, manufacturing, CAPEX, and and what's also happening in trade volumes. But when that starts to spill over into the labour market, then the first one which we're looking at very closely is this spike in jobless claims, to give us a really clear sense that we're heading into a recession, and that's really going to be what we're looking at. Part of the Conference Board's consumer confidence number is this sub-survey where they ask respondents, do you see jobs as plentiful versus jobs hard to get? And we look at this as a ratio. So you can see here that jobs plentiful have been going up relative to the perception of people who see that jobs are harder to get. But then we see this huge reversal coming through, and we see this big pivot. And when we see that the number of people saying that jobs hard to get is going up relative to people who are saying jobs are plentiful, that generally is another really good a precursor of what's going to happen with periods of negative growth, or what we call a recession there. So we see in 1998, 89, that ratio flipped, and we saw people saying that we're seeing jobs harder to get, and again that came into a recession. That same situation, we got up to a really lofty level between 92 and 2000, and again that ratio then flipped, and people said we started seeing harder to get. At the moment, we're not seeing that point. We haven't got that as a trigger point in the labour market. But when people start saying that jobs are harder to get, and bear in mind just how lofty we are, again, when this starts to reverse and the rate of change picks up, again, it's going to come onto my radar that we're coming very close to a much tougher times. The labour market's going to crack. Of course, if the labour market's going to crack, what's going to be the knock-on effect? The real hit is consumer confidence. Now, consumer confidence is really interesting in the US. And if you have a look at the white line here, you can see the Conference Board consumer confidence number, which is the main number. And again, multi-year highs playing through at 135.1. And that hasn't cracked. But again, when we see consumer confidence coming off, it goes into recession. Of course, if people are feeling bad about their labour, their employment situation, you're going to refrain from those purchases. At the moment, that's not the case, and we don't have that cracking. Of course, this is going to be something that definitely comes onto the Fed's radar. So there's, Sean, you talk about the idea where the Fed still kind of see us in a mid-economic cycle, and what they're doing is an adjustment within that process. One of the things is that the consumer is still very strong and very confident. Now, the interesting dichotomy here is that you have got this divergence playing through in the smaller sample of the University of Michigan consumer confidence numbers, which have held a fairly good proxy. And one of the things you were pointing out was the divergence there, Sean.
Yeah, well, you can see, you know, we're looking since the 1980s here, and if we'll start here. Halfway, you know, until halfway through the cycle, they're tracking along side by side, but then all of a sudden the larger sample of consumer confidence really takes off, while the University of Michigan sample, which is smaller, you know, carries on a steady sort of path. And we've got that divergence. You know, we're into a recession, the red area here, and it happens again halfway through the cycle. The divergence takes off, and to a smaller extent, it happened here before the GFC as well. So seeing the divergence here, to me, looks like perhaps we're closer to an end of a cycle than a mid-cycle. But as you said, the US consumer continues to spend, Chris. They're championing the US economy.
Yeah, I mean, consumption as part of the GDP is still very strong. I think that's an interesting one. So I think when the trigger point here is do we see convergence between the CB consumer confidence numbers and the University of Michigan? That's kind of tended what we're seeing. I think the other issue is that there's been a strong correlation between the S&P and consumer confidence. I don't think that's necessarily going to surprise anyone too much, but this is what we're looking for. So we're looking for that downturn in the CB consumer confidence numbers, which comes out actually tonight. But if that starts going down, converges with the university, that has been, okay, we've got 3 sample sizes here, but you know, that's been a pretty good consumer situation. Again, that would probably coincide with that spike up within jobless claims. If people are feeling bad about their economic future because they're concerned about their labour market situation, you know, you are going to see that resonate as that lagging indicator, consumer confidence. And the very degree by which consumer confidence fall, I think, will dictate things like retail sales and obviously consumption as part of that GDP print. So we're looking at those 5 indicators. We're looking at consumer confidence. We're having a look at jobs plentiful, jobs hard to get, jobless claims, core CAPEX orders, and also the leading indicators. So for me at the moment, none of them are really giving me a red flag. But when they do, and there are a few reasons to believe that that could be the case, then I would suggest that we are going to see much tougher times, not just in the US, but also in global economies. And I think we have these very much firmly on the radar. So we are watching this as we go along. Of course, we'll be updating clients if we see any of these trigger.
The Federal Reserve have been saying they want to do all they can to sustain the economic expansion, and we've had a couple of insurance cuts. They're going to keep it steady for now, it sounds like. Meanwhile, we've got President Trump calling for 100 basis points of cuts, even towards negative rates. The reserve banks around the world are starting to call for fiscal stimulus, though. Governments are hesitant. I know that the RBA is calling for fiscal stimulus, yet the Morrison government wants to, they're focused on a budget surplus rather than any serious fiscal measure. So this means we still have to look to monetary policy, Chris. Is it still the answer?
I think the worse this gets, the higher we've got a higher chance we've got of a fiscal response. But I mean, if we have a look at what markets are pricing in at the moment, they still see the most likely situation as a monetary policy response. Now, I think depending where you are in the world, we're more likely to see cash rates still coming down in Australia, same in New Zealand. And I think this chart tells you what's being priced in across the swaps curve. And I think if you go on the right hand side, the market still sees the response in the near term coming from monetary policy and one of 2 things. So I think the first one is what's happening in rates. If you go down to the right hand side, you can see the market's still expecting 58 basis points of cuts from the Fed. That in a 1 year time takes the Fed funds rate down to sort of a trough down to 125. We've got Canada expected to take another 1 rate cut over the next 12 months. Australia, we're looking for 2 rate cuts, 54 basis points, takes the cash rate down to about 50 basis points or so. Our view is that, once we go through 50, probably when we go through 75, the idea of unconventional monetary policy settings steps up. What are going to be the trigger points for the RBA to do more on things like QE and asset purchase programs? But I think the market is still saying, right, on balance, what we know now, that there will have to be a central bank response. Now, I think the talking point in Europe, of course, is that we've got QE infinity. They're doing 20 billion euros a month now with asset purchase. What does that mean? Bank of Japan probably will have to do more in its next meeting. That next meeting in October is a live meeting. And the Fed, of course, are going on this idea of balance sheet expansion now. The difference between QE now, what we coined as QE light, and what we saw in previous bouts is that previous bouts of quantitative easing and expanding its balance sheet and creating excess reserves was really aimed at increasing reflation and certainly looking at asset price reflation as well. This time around, it's about the scarcity of reserves, and the Fed have probably over tightened in that situation. But yeah, I mean, if you have a look at this, you can see now that the markets are still expecting quite an aggressive monetary policy response. I talked about my model being the difference between 3-month treasuries and where the neutral rate or the perceived neutral rate, the market neutral rate is. But have a look at the 5s versus 2-year US treasuries and what that means for policy over time. You can see here when the 5-year treasury yield was lower, than 2 years. So we became inverted at the front of the curve. You can see that as soon as we go through 0, which is this kind of light blue dotted line, it was about 68 days until we started seeing a rate cutting cycle in 1989, and we saw the Fed funds rate, you can see on the lower pane here, being aggressively cut. And suddenly we got to a point where we started seeing steepening and 5-year yields moved up more aggressively into a recession. Most people look at 2s, 10s, or we can see 3-month against 10 years. But I think US 2s, 5s has been quite an interesting one as well. Very sensitive to short-term rate moves. You can go into this period here where we got in 1988, we got inversion, so 5-year yields trading lower than 2-year yields. There was 8 days until we started seeing a rate cut there. So we could see a couple coming through. Again, in 2000, similar situation where 5-year yields traded lower than 2s, and we saw this really aggressive rate cut coming through in 2000. And then we saw the steepening playing through there. But that same dynamic is now playing out. I mean, this has been a really good precursor of what's happening in Fed policy. So 5-year yields are currently trading about 1 basis point below where the 2-year are. So you've got inversion at the front of the curve. And we've already seen the Fed cutting rates twice there. The market's saying that we'll probably get down to 125 or 129. So yeah, we've got that inversion there. So this has been a really good precursor. What we need to say now is that 5-year yields start moving up. So there's better selling on a relative basis in 5s relative to 2s. And that will give us a pretty clear idea about the extent of rate cuts playing through. But again, it sort of feeds into the idea that Fed policy is probably a little bit too tight. And this has been a pretty good precursor that we are going to see rates coming down. So monetary policy is still very much the answer in the market's eyes here. I think the other big issue is what's happening in liquidity. So liquidity is the oxygen that breathes life into financial markets. And you can see the influence that this has had over the course of time. You can see that the G3 balance sheets, so the red line here, which is the balance sheets of the ECB, the Bank of Japan, and also the Federal Reserve, that increased significantly from 2008, mostly from the Fed, who are expanding its balance sheet, buying mortgage-backed securities and US treasuries from commercial banks. Obviously, that created excess reserves. A lot of that went back into the financial markets. And there was a correlation between what was happening in the MSCI World Index, which is heavily weighted towards the S&P, and also what was happening in the balance sheets there. So they were printing money effectively, increasing the monetary base. Now that balance sheet obviously has declined about 16% or so from 2017 as the Federal Reserve were obviously letting its assets roll off as they matured. They didn't reinvest the proceeds. That balance sheet is now ticking up a little bit, mostly because the ECB are coming back in, but also because the Federal Reserve now are supporting the repo market and effectively trying to bring liquidity back to the systems. They probably over-tightened. There's a scarcity of reserves. Banks need cash. And that balance sheet now is going to tighten. I think there's also an implication for the US dollar in that situation. But also, if you have a look at money supply, now we've used the broadest measure. I think this is M1 money supply. So we're looking at credit creation here, and you can see again a lot of that credit creation is supporting equity markets. With the idea that we're getting lower rate cuts coming through as well, or more rate cuts coming through from the Fed funds rate, this to me is somewhat supportive of the equity market. For me, the most important thing for the S&P and for global equity markets is not so much earnings. It is about liquidity, and liquidity dynamic in the short term is actually changing. But the rationale for why that's happening is a bit of an issue. So I think this chart's really interesting. And if you zone in, you can see here again the MSCI World Index, the white line, had a little bit of a pop recently. And why is that? Well, I think money supply has been probably the reason. Money supply has been pushing up. The balance sheet's been moving a little bit higher on the G3. And again, I think this is the most interesting dynamic. This is the one we're looking for. So whilst we're seeing some precariousness in certain parts of global economics, if you're an equity trader, still for me the most important situation is what's happening in liquidity in markets. If the Fed are going to increase liquidity, the ECB are increasing liquidity, the Bank of Japan might do more, and money supply might continue with what's happening certainly in China with the credit creation there. That will be supportive of equity prices who are looking at liquidity very closely indeed. So just to wrap it all up, I think, you know, we've looked at the fact is that when we're talking about recession, Sean talked about the idea that, you know, more people are searching for this. It's certainly being focused a lot about in markets at the moment. And yeah, rightly so, some of the forward leading indicators such as trade volumes, such as CAPEX and manufacturing has looked quite precarious. But now what we need to see is whether or not that spills over into the other part of the economy, which is still a fairly strong service economy, the labour market, and also consumer confidence and consumer spending hasn't been yet affected. We've looked at, therefore, the trigger points for what would be a much more prolonged period of economic vulnerability, which I spoke about the measures that I've looked at, which are things like jobless claims, consumer confidence, and what that means for asset prices. And I think the other issue is what's happening with balance sheets and liquidity as well. Will there be a fiscal response? Well, I think at some stage there will have to be. But at the moment, you know, we're analysing the markets. We're trying to understand what's happening with recession, and we've looked at the indicators that we're going to be focused on. So thank you very much for joining.
Thank you, everybody.
And if anyone's got any questions around what they've heard today, I want us to explore a little bit more, do reach out on the details you can see in the YouTube link, and we'd be more than happy to sort of ascertain or entertain any of your questions. But thank you for joining, and you know, we hope you've enjoyed and found the information useful.